Hey guys, Kevin Bupp here, and I know you're probably wondering what the heck I'm doing here at the beginning of the show. Well, I want to make a quick apology to you. You see, you're about to hear the kick-ass interview that I did with Hunter Thompson on self-storage investing, and although the content that we covered is a 10 out of 10, the sound quality is a measly 5 out of 10 at the best, okay? I had a little hiccup occur with my mic, and I didn't realize it until our call was all the way through. Anyway, I'm sure that you will enjoy it, and we'll still get a ton of value from the call.
You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here with another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is self-storage expert Hunter Thompson. Now, Hunter is a full-time real estate investor and the founder of Cash Flow Connections. Since starting CFC, Hunter has helped investors allocate capital to over 100 properties, which have a combined asset value of more than $350 million. His experience includes investments in self-storage facilities, residential mortgage notes, mobile home parks, single-family acquisitions, hard money loans, office buildings, and multifamily real estate syndications. In connection with these investments, he has worked with some of the most experienced and well-respected asset teams across the United States and Canada. Hunter is also the author of Little Boxes, Big Profits, Passive Investor's Guide to Self-Storage. But before we get on to the show with Hunter, I'd like to briefly run through a few updates for you guys. First and foremost, this is a big update. This is a huge one. As you guys probably already know, if you've been listening for any period of time whatsoever to this podcast, then you know I've been investing full-time as a real estate investor for, that's actually more than 18 years now. And I've owned hundreds of single-family rentals. I've owned hundreds of apartment doors, along with a slew of other miscellaneous commercial real estate investments along the way. But up until about 5 years ago, I really had no clue what I was missing until I discovered what I consider to be the holy grail of real estate investments, and that is mobile home parks. Mobile home parks are the holy grail. To me, at least, they are. And so my business partner, Charles Dehart, and myself, we're releasing a book. That's the big announcement. We're actually releasing a book on mobile home park investing. And this isn't something new. We've been secretly working on it behind the scenes for more than 2 years now, and we plan on completing it within the next couple of months. And the reason I mention all this to you is as a gift to you, my loyal listeners, and prior to putting it up for sale on Amazon, I'd like to offer you a copy absolutely free. Now, I will promise you that this will be the most comprehensive book available on the topic of mobile home park investing. And to get on the VIP wait list, just text the word Kevin, Kevin, text the word Kevin to 41411. Again, just text Kevin to 41411, and I will put you on the list to be the first to receive a copy as soon as it's completed. And just a few more items here I want to go through. Guys, if you're listening to the show and you're an accredited investor and you're listening in because you're trying to figure out ways to create cash flow and you want passive cash flow, you're looking for a passive investment opportunity, then you need to check out the partnership opportunity that me and my team have at Sunrise Capital Investors. That's the parent company that we essentially acquire mobile home parks in. And we're currently looking for investors who are seeking above average returns to partner with us on deals. And I will tell you that I have my finger on the pulse of the various other types of real estate opportunities that are out there, whether it be multifamily or the other commercial real estate niches that exist. And I haven't seen any that can hold a candle to the opportunity that we're offering. So if you'd like more information on our company and you'd like to download our investment prospectus, you can go to our company website, which is sunrisecapitalinvestors.com, or you just give us a call, 888-260-9455. Again, the website is sunrisecapitalinvestors.com, or you can just pick up the phone and give us a call, 888-260-9455. And just another quick thing I want to mention about this investment opportunity. I will tell you that a large majority of investors, our current investors, that they're currently taking advantage of investing with us through their self-directed IRAs. And so I will say this, if you currently have a retirement account that isn't performing up to your standards, then we need to talk, okay? Get a hold of us. We have partnered with Advanta IRA. They're a national company. It's actually the same company I use for all my self-directed investments, and they're here to answer any questions for you. And we've even got a personalized landing page that has more information about Advanta IRA. I'm going to put it in the show notes because you're probably not going to be able to remember it. It's info.advantaira.com/Sunrise Capital. And I'm going to, again, put that in the show notes so you can just link to it directly. And one last thing here I want to mention. Charles and I, my partner that we're writing the book together, and he's one of my partners in Sunrise Capital Investors. We've got a little, I guess, another gift we'd like to offer is anyone that invests with us through Sunrise Capital Investors, anyone who partners with us on our opportunities, we're offering lifetime membership to our Mobile Home Park Academy training program. And this academy, you're going to learn the mechanics, the actual mechanics, the operations of the mobile home park investing business, and actually have the opportunity to be taught directly by myself and my team. And this is really for those individuals who want more of an active role. Like maybe you have a passive investment, but you actually want to know the mechanics. You want to learn the business firsthand and see how a successful mobile home park business or a real estate investment company operates. Well, this is it. You passively invest with us, but we will give you access to the academy because maybe one day you want to go out and buy your own mobile home park. Well, then you'll know exactly how to do it. Again, you guys can connect with us and learn more about this investment opportunity by going to sunrisecapitalinvestors.com. And actually, I got one last thing here really quick. If you happen to be in the Tampa Bay area, I'm located in Clearwater, Florida. As you guys probably hear me say this all the time, I'd love to meet you. So if you're visiting, you got some extra time, let's coordinate a time to get together, whether it be a coffee or beer, lunch, whatever you have time for. You can just shoot me an email. My personal email address is kevin@kevinbuff.com. It's pretty easy to remember. So shoot me an email. Let me know when you're coming to town. Let's see if we can coordinate a time to get together, okay? So without further ado, now I'd like to welcome our guest for today's show, Hunter Thompson. Hunter, how's it going, buddy? You there? You fall asleep?
Very, very well. That was quite an introduction, and I'm very happy to be here. Thanks a lot.
Yeah, well, I appreciate you coming on the show, and I gave you a little bit of an introduction. I told our listeners a little bit more about who you are. You've got a lot of experience. You've done a lot of transactions. You've been involved in a lot of transactions. But from your own words, maybe take a few minutes, tell us a little bit more about who you are and how you got into this business.
Yeah, sure. So, I think that the big paradigm shift that took place in 2008, that was something that got most people's attention, obviously. For me, I wasn't quite 100% sure that real estate was the best option after 2008. I knew that there was a lot of opportunity just because asset prices all over had collapsed, stocks, bonds, everything had collapsed. And so I was interested in the space. It didn't really click until 2010. And the reason I say that is that's when the European debt crisis really was taking hold and making insane volatility in the United States stock market. So I was living in Los Angeles, and I still do live in Los Angeles, and felt compelled to wake up to watch the market open because of what was going on overseas. And I remember watching CNBC, and they were talking about the Greece bond yields, and how if the Greece bond yields went above 7%, the S&P 500 was going to collapse. But if it stayed below 7%, the S&P 500 was going to be fine. And it would create this crazy volatility that I have no capacity to predict or mitigate. And I'm just thinking, it cannot be worse than this, right? Like, how could I ever have the capacity to predict the Greece bond yields? And why do the Greece bond yields have anything to do with my portfolio whatsoever? And this kind of, turned me on to real estate because the overall simplicity of the investment. Now, I may say something later that may counteract that, but the reality is no matter how complicated the asset class, it's very simple compared to trying to do something like predict the Greece bond yields, at least from my perspective. So that was kind of my introduction into real estate. I moved out to Los Angeles and, there was devastation in the California market and started going to networking events. And it was really favorable timing, obviously, to enter the market. But I think even more important than that was that at these networking events, only the strong were surviving. I mean, there were small events with some of the major players in the space and people that were able to weather the storm. And so that network, going to networking events with 5 people where every single one of them are quite successful, that snowballed into something which ended up being my career in real estate.
Okay. So when you first decided that you wanted to take a step into real estate, you started going to these investment meetings. At that point, was that when you were introduced to self-storage, or did you start dabbling in other asset types prior to moving into the self-storage space?
Yeah, so I really was just trying to be as diversified as possible. I was trying to make it so that I never had to wake up in the middle of the night thinking about something like that again. And so the diversification was my number one goal. The first investment I ever made was what we consider now to be a very lucrative hard money loan at 13%. on a 60% LTV performing note for 7 years. If I could do that right now, I would. But, those markets have kind of changed significantly. But, since that time, I've invested in virtually every type of real estate transaction that exists, as long as it's within the value add to stabilized risk profile. I'm relatively risk averse, but I think that the most lucrative returns on a risk adjusted basis are probably in that value add range, where there's proven demand for the property, but there's a way to effectuate a change which will result in a more lucrative return.
Yeah. So I want to take today's time together, Hunter. I mean, we could talk. It sounds like we could probably spend hours and hours talking about real estate in general, because you've got a very diverse background and lots of experience in multiple asset classes. But today, I really want the focus to be self-storage, right? I mean, you've got a lot of experience in that space, and that's a topic that we've talked about before on the show. We've had other experts on the show, but it's been a while. So I'm looking forward to diving in. And, for those listeners that are out there that maybe don't know too much about the self-storage space or have never even considered it as a potential investment, I want to speak to those people. I want to leave this show with, make sure that everyone has a better understanding of why you're so excited about self-storage and why it truly can be a very lucrative niche to get into. And so my first question for you, it's a pretty simple one, is why self-storage?
Yeah. So, I mean, I mentioned that I was kind of risk averse. I was really drawn to the recession resistant assets very quickly because of the fact that, to me, if the capital markets are loose and the economy is booming, every type of real estate is going to do well. Right. And so if you can find those type of real estate assets that are going to perform well during recessions, you're going to be in a much better place comparatively, because you're going to be able to receive the benefits of the upsides, but you're not going to have as much downside you're going to have much more downside protection. So for me, the real reason of why self-storage is that it's recession resistant. And this is because the demand for the product is at a minimum stagnant, if not increasing, during economic shifts to the downside. So you think about why people use this product. We're talking about foreclosures, layoffs, downsizing, kids moving home from college unexpectedly, job changes, etc. And all of these are more common during recessions, and they all increase the demand for self-storage. And then something else to consider is that the tenant base is incredibly sticky. There's many reasons for this, but the most important one is that the gross dollar amount is just not that significant when it comes to rental increases, because there's just not that much money involved in the rental increases. So if you have a typical 10 by 10 unit that rents for, let's say, $100 a month, to keep the math easy, if you have a 6% rental increase, which is pretty unheard of in multifamily, you're only talking about $6 a month in self-storage. So then the question becomes, is this tenant going to take the time off work, go down the street, rent a rental truck, hire movers, blah, 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 for $6 a month? Overwhelmingly, we've found the answer is no.
Is no,
and so,
yes.
Exactly. And you compare that with something like, let's say an average 2-bedroom apartment for $1,200 a month, 6% rental increase, that's like $75. And that makes a difference on a lot of people's budget. So, the sticky tenant base and the recession-resistant component is really the two major things. And there's a couple other issues we can get in as well, but those are the major ones.
It's interesting because I'm building a house right now, and I literally dread the day when that house is completed. Not because I'm so excited. It's like exactly where we want to be. We're building kind of our dream home. But that day comes, that means, or I guess a month prior to that day coming, when it's completed, I've got to, even if I'm not going to physically move it ourselves, like we've got to hire, we've got to coordinate, and we just... Us Americans, I'm going to generalize that statement, we accumulate so much stuff, and I'm guilty of it. You just have a lot of stuff, and I dread having to pack everything up and move it and then unpack it again. And so that's why you're mentioning like a 6% rental increase. Like, is someone really going to move their stuff out going from $100 to $106? And the answer is no, because it's a pain in the butt to have to move all that stuff out of there. And actually half of it, they probably don't even really attribute a value to anymore. They're like, why do we move that in there? Well, gosh, we got to move it out. Even if we don't want it, we got to move it out still. And then it also, you're familiar with Planet Fitness. It's a national fitness chain, a gym chain. Do they have them out there in LA? I'm sure they do. Yes,
okay. They do.
Well, it's kind of the same thing with that is, their whole shtick is $10 a month. I mean, it's no frills. There's no classes or anything like that. But, most people that have a gym membership, they don't even go to the classes. And so it's no frills. It's $10 a month. But I actually heard this from one of their franchisees. Is like the business model revolves around making an amount each and every month that is so small that it's more of a hassle to call the gym and cancel your account than to just pay the $10, thinking, you know what, sometime in the next year I'm going to go. And
Right.
it's just, I'm just going to keep the membership. So kind of the same thing with self-storage. I mean, at least to a certain extent.
Absolutely.
So, I want to talk a little bit about, you mentioned that self-storage is somewhat recession resistant. Do you have any statistics available where you can speak of like how it performed, 2006, and then kind of show us a difference of what it looked like 2008 and 2009? I mean, was there an actual performance increase, or, was it pretty stagnant, or was there a drop?
Yeah, it's a good question. So a couple things to consider. Self-storage experienced a massive boom that started in the late 90s or mid 90s, where the number of self-storage facilities went from somewhere in the 20s to now there's about 53,000. So there's 53,000 facilities in the United States. That's the same number as all the Starbuckses, all the McDonald's, all the Subways combined. So this is a major asset class. Now, during that boom, occupancy still remained about in the 80s or 80% or so. And so when you look at an NOI basis, while it was experiencing this massive boom, occupancies remained in that range and NOI was either stagnant or increasing, or there's a slight decrease right in the middle of 2009, but nothing you would be super worried about, from my opinion at least. But here's the key with all these asset classes, and you definitely know this from mobile home parks as well. The real challenge with these asset classes is cap rates tend to fluctuate, and to double down on that is the access to capital can fluctuate. So the real concern with recessions is not about NOI. People are going to need the product. That's going to keep coming in. So what I want to focus on is making sure that I get appropriate leverage and appropriate debt service coverage ratios, and make sure the term of the loan is long enough to implement some value add strategies to add value to the property. Because in my opinion, if you're going through a recession, it's not going to be a great time to sell. What you really want to do is hold. The problem is if you're forced into that position because of a loan term coming due, that's when you have some real serious problems. So I think the combination of the stagnant NOI or solid NOI and an appropriate leverage allows you to kind of weather those storms.
Now you make a good point. So that kind of brings on to my next question is, it sounds like you guys at this point in the game, at least, you're more value add investors. Is that correct?
Yeah, and that's, I love to invest in stabilized opportunities, but in 2012, 13, or 14 or so, it became more challenging to get the kind of returns that I look for. So this led me to value add focused investments as a whole. And because of my recession resistant inclination, I was very led to self-storage. The reason for this, and this is another reason I just really like this asset class, it's incredibly complicated, right? It has some drawbacks because of the complications, but the reality is, if you're looking at a spreadsheet, each line item can be optimized for maximum efficiency. And there's so much mismanagement out there. 77% of all the facilities in the United States are owned by independent owners. Many of them are mom and pop. Really? Independent owners, right? So non-REITs, right? So that doesn't mean they're all mom and pops, but there's a lot of mom and pops out there. And they don't have the systems in place. They don't have the protocols to implement or run an efficient facility. There's several examples I can give, but merchandise sales, for example, mandatory tenant insurance, U-Haul components, these things can add tremendous value, but they're not really capital intensive, and therefore the risk is really mitigated.
Interesting. So who are the typical buyers of these stabilized assets, which are don't really meet your overall investment objectives? I mean, are these like the REITs? Are the REITs looking for the more stabilized assets at this point in time?
I'd say that generally speaking, REITs are going to be in that range, but there's also private equity groups, not as much, but there's also private groups that look for stabilized only. Let's say that people are not in the wealth accumulation stage in their career, and they're trying to just protect capital because of the fact that the NOI is relatively stable. You can justify buying a property that's 85% occupied and, more importantly, 75% economically occupied. You're renting it at a reasonable rate. You can get up to an 8 or 9 cap or 8 or 9% return, and people are doing stuff like that out there. That's just not the strategy that I implement, because I think that because of the sticky tenant base in particular, you can add a tremendous amount of value by implementing like a U-Haul strategy, for example. So this is pretty much zero capital expenditure goes into this. It's a matter of leveraging a relationship with U-Haul, allowing U-Haul to park their trucks on your facility and renting out those trucks to a tenant. And when you rent those out, you get a commission from U-Haul. And I have personally invested in properties where that line item went from $0 a month to $3,500 a month directly to the bottom line.
Wow.
So you're talking about $600,000 in equity, let's say at a 7 cap or so, that you just added. And again, the key there is risk-adjusted basis, right? You didn't build something. You didn't deal with timelines and contractors and, zoning requirements and stuff like that. So that's really, I think that's really favorable.
And you've already got a manager on staff that's there. There's a physical body present, correct?
Exactly. And there's different strategies with that. I'd say that, the sponsor that we work with, we want to have an on-site property manager that lives in the facility. And, in the industry, there's kind of a debate as far as who makes the best property manager. I end up on the side of things where I would prefer a younger entrepreneur type of property manager that's looking to move up in the company. Other people may say, looking for a retired couple that just wants some easy income and a place to live.
So that's still a common part of the business model then, is actually having a manager live on site. I mean, that's still a very common practice.
Yeah, and the properties that I invest in, that's mandatory. And I think that part of that is, looking at A-class properties versus other classes. I'd find it very uncommon, at least from what I've seen. If you're looking for an A-class property, you want someone there 24 hours a day. And so that comes along with, having an apartment on site.
Well, that leads me kind of to another topic I wanted to discuss. I was planning on talking about a little bit later on, but since we're chatting about it now regarding management, talking about automation and how that's really playing a role in the industry. Because I spoke to someone not too long ago that is in this space. They're not a huge operator. I don't know how many thousands of square feet they own or how many facilities, but they're in the point where they're kind of retrofitting or somewhat repositioning their properties and trying to switch them over to a kiosk model, to where there's no physical manager present. What are your thoughts on that? And is that a viable business model?
Yeah, that's a good question. And I'll be honest, I'm not probably the person that's going to be able to answer that best. And I'll tell you why. I saw a webinar on it recently and I booked it in my calendar and I missed the webinar. Now, just to be clear, I have seen these type of businesses before, but my kind of gut intuition on that is that it's probably leaving some money on the table for a couple of reasons. The upsells that are potential when you have someone there to sell them on climate controlled unit as opposed to non-climate controlled unit, to sell them on having drive-in as opposed to inward facing, or first floor as opposed to second floor. There's just so many ways to upsell the product that I don't think a kiosk will be able to effectively do those upsells. Now, I could be wrong about that. Like I said, I haven't even seen a pro forma on those type of opportunities. But when you're looking at A-class properties, you're really trying to create an environment that is safe, welcoming, etc., so that people will do things like purchase more of your merchandise. So again, I'm more on the side of 24-hour management and allowing for that upsell potential there with a person. But I'm always interested in looking at that stuff. Something else that comes up a lot is there's a startup that has billboards all over Los Angeles that say, "Self-storage is stupid." I'm like, oh, good. That's going to be great for business. And it's basically an on-demand self-storage app. So essentially you text the app and say, "I'd like you to come pick up my stuff." And they drive it away from a major metropolitan area and store your stuff in a warehouse. And it's much cheaper than self-storage and it's on demand. The issue is that we don't look in markets where that's viable, because in something like Fayetteville, North Carolina, driving an hour away doesn't make it vastly cheap. Like imagine Manhattan, right? If you drive an hour away, the price per square foot drops by 98% or whatever. So we happen to not be looking in those markets because we're looking for cash flow. So, but
that's
those
a
are
very
the two things.
Business model, though. That's very interesting. That's a great.
I wish
idea.
I'd started a company. Definitely.
Is it just one company in that space at this point in time, or are there multiple others jumping on board with that concept?
There's some competitors for sure, and again, I think it's a great idea. And knowing a little bit about the business, it's probably there's gonna be a winner in that space for sure. But it's not something we're concerned about because of the markets we're looking at.
Yeah. So talk to me a little bit about conversions, or I guess call it a retrofit or a refit. It's pretty common to see this. In fact, I mean, just literally, I pass it on my way home from my office, going back to my house each and every day. It was an old bowling alley in Clearwater, Florida. And I think Public Space, I think they're the ones that converted it. I mean, they just did it's a massive facility. I think they even added on to it, but they took an old, bowling alley that literally had shut down like 2 years ago and retrofitted it and converted it into interior self-storage. Talk to me a little bit about that business model, because it seems like that might be a very viable strategy, especially with the number of like big box retailers that are going out, right? These big dark spaces that are in these older, 80s, 70s and 80s built, shopping centers that aren't necessarily in the path of progress anymore. They're kind of off the beaten path, but they've got these 80,000 square foot big boxes that have been sitting dark for 10, 12 years. And probably more of those are going to come along as Amazon, the big retail killer, puts their stake in the ground even deeper. So talk to me about that a little bit, that business model of converting an existing building versus building from the ground up.
Yeah, I think you bring up a lot of good points there, and it's all very valid. I'd say that my strategy is one rung a little bit away from the risk that goes along with some kind of refits like that, major refits. It's definitely a good strategy. I've seen deals like that. But in my opinion, because of the mismanagement out there, the combination of the mismanagement and the sticky tenant base, and the fact that, like I mentioned earlier, the size of the entire industry doubled in the course of like 12 years or something. So there's all these facilities out there. Many of them are incredibly mismanaged, and you can just buy them with the in-place tenant base and raise rents, raise occupancies, implement those value-add strategies, and for me, that achieves those goals I'm looking for. Now, if you want to, take advantage of the fact that I think you're dead on in terms of the struggles that retail is going to be facing over the next 5 or 10 years or so, that opportunity may really start to be more effective once once this bad management, which is really rampant, has been cured by the market. I think that will start to be the appropriate strategy. For me right now, I think that the sticky tenant base, they're just sitting there waiting to have the rents raised. There's plenty of properties out there that you can, get lucrative returns without taking on that additional risk that goes along with development.
How many mom and pops do you think really exist out there? Like, I know I think you referred to it as independent owners or private owners, or I don't know what word you gave or what label you gave it. But I mean, let's talk about mom and pops for a second, because this business, if you could find a business that was, had some similarities to mobile home parks, self-storage is it, right? With regards to it's somewhat of a new asset class. It's only been around for how many years? Like 30 years, maybe 35 or 40 years at the most. And same with mobile home parks. Mobile home parks have been around a little bit longer than that, but they were both kind of just oddball asset classes. 25 years ago, there weren't really many big names in the space. They were just mostly mom and pop owned investments or properties. Now it's a completely different ballgame. They're becoming a little bit more refined. Larger professional investors are grabbing onto the space, but there's still a lot of mom and pops left over that are mismanaging their properties. So do you have a rough number based on like the size you guys look for and the markets you look for? How many real mom and pops? I'm talking like single operators, or maybe they own like 2 facilities like in the same town or maybe the next town over. How many of those types of properties are left?
Man, I can't give you a good answer. I don't want to guess,
Okay.
but plenty. And you mentioned mobile home parks earlier. Someone's going to tell me that mobile home parks are the best asset class in the United States. I'm never going to argue with them. It's an amazing asset class. The key difference, I think, between mobile home parks and self-storage are those complexities. So the truth is there are many, almost every single deal that we look at is going to be from someone that owns only one facility. Mm-hmm. So that is going to be so many. I mean, to answer your question directly, there are plenty of properties out there where the independent owner is the property manager and that's their only property. And because of that, they just don't have the economies of scale that is required or the protocols that goes along with kind of running an appropriate property. This is in terms of things like rental increases. I mean, because of the fact, similar to mobile home parks again, because of the fact that you're on monthly leases, you're able to raise rents very quickly upon purchase and intermittently in the year. So we have developed a track record in conjunction with our sponsors to be able to raise rents twice a year effectively, and that can still be in that 6% rental increases. That those can take place more than once. So there's still opportunity in the space.
Yeah. And how large of a facility, like what's your minimum? Like someone asked me like, hey, what are you looking for in mobile home parks? Like our minimum size now is kind of like 50 or 60 lots. And obviously there's no maximum size, but with regards to the self-storage space, do you guys have a particular size minimum that you're looking for?
Yeah, definitely. So I'd say that somewhere in the range of $4 million is usually the lowest that you're going to see, at least that's something that I'd be interested in looking at. A lot of this has to come down to, we want to see 50,000 square feet or so.
Okay.
This is
so that's
at
50,000 square feet. Okay.
Yeah, and that's going to result in about 400 units. And I think that gives you enough tenant diversification, enough unit types, enough of a facility essentially to kind of weather any kind of storm. You're going to have some seasonality in the asset class. Most markets, the summers are going to be the big months. And so, you want to be able to balance that out with enough tenants to kind of provide cash flow throughout the year.
Okay. Sounds good. So talk to me a little bit. I want to go into like the more of the particulars regarding like underwriting. For mobile home parks, someone can kind of give me a hypothetical, deal on, and I can, tell me who pays for the expense or who pays for the water and the sewer, how many rental units are in there versus tenant-owned homes, this, that, and the other. And I can come up with a general rule of thumb for expense ratios, and I know what's good and what's bad. I know general price per unit based on marketplaces and other things like that. So talk to me about that as far as self-storage is concerned. I guess first off, the big question is like, what is like the normal expense ratio that these things should be running at? And that'd be based on like the size minimums that you guys are looking at, like a 50,000 square foot facility that has, roughly 400 rentable units.
Yeah, sure. That obviously is the big one. And I'd say that, 42% is going to be conservative. 40% is probably more realistic. And there are deals out there that are performing under 40%, especially relatively new builds, or if you have some kind of expansion with climate controlled units, you're going to be in that 40% range. Okay. Sounds good.
And how about price per unit? Does that come into a factor, like of what you guys are looking for, like what might be a good opportunity for you?
Yeah, so obviously units are going to vary because the unit sizes vary significantly. So if there's one property that only has really large units, it's going to be cheaper. If there's one property that only has 5x5 units, it's going to be more expensive on a price per unit basis. So usually cost per square foot is going to be more valid. In the markets that I like, this is like Midwest, Southeast. Florida is a great self-storage market just because the demographics are so favorable in terms of retirees moving there and just population growth overall.
And we don't have basements. We can't store our junk in our basement.
Interesting. That's a data point I haven't discussed yet. That's a good point. I'd say cost per square foot, 67 to maybe 120 or so, depending on the market. Okay. And
does the actual unit mix come into consideration as far as like how many 10 by 10s, how many 10 by 20s, how many 10 by 30s or whatever size 5 by 5s? I mean, do you guys look at that? Is that a big concern as far as what the existing unit mix is, or is it not so much because it's really probably not overly expensive to take a 10 by 20 and convert it into two 10 by 10s. Am I right with my thinking there?
Yeah, you're dead on there. And I think the key in terms of unit types can be a potential for, identifying mismanagement. So if you notice when you look at their P&Ls in escrow, or if you're trying to purchase a property and you see that all of their 10 by 10s are rented and their 5 by 10s aren't, and they don't have enough 10 by 10s, let's say, for example, that, typically I've seen deals where I'd say close to 40 or almost 50% of the entire facility is 10 by 10 unit. That's a standard box. That's what people are most used to. If the unit types are not appropriately rented, then that can be a potential for a value add. Something else is the climate controlled as a value add as well. So in almost any market, there's going to be a market for any market you want to be in. There's going to be a market for people that want to rent climate controlled units, and those should at least be offered on the facility, if not a significant portion of the facility. It's always good to have both so that you can cater to both kind of individuals and potential tenants, but it's a great upsell once you're on the property to say, well, listen, if you want to keep that art or your family heirlooms safe, you should pay the extra $25 a month for a climate controlled property.
This is going to be an off-the-wall type of question, but I need to add some humor in here. So we're talking about climate control. We're talking about climate controlled units, right? Have you ever run into a situation, or your sponsor who you work with, or I'm sure you've probably heard stories of it, but to where you actually have people that try to live in these units? Has it ever occurred?
There's tons of horror stories, right? It's crazy. I mean, there's definitely stories of people that are set up a gym in their place. There's people that in California, there's laws specifically outlining, why you can't live in a self-storage facility because the properties are so expensive here. But I'd say that the vast amount of those issues are a result of mismanagement, because people that are doing crazy stuff like doing drugs and stuff like that, they have the tendency to not pay or not pay on time. And because of the fact that you're dealing with 30-day leases, if you implement a no pay, no stay policy, 95% of those problems are gone very quickly when you purchase a property. So, that's kind of my answer there.
Okay. Sounds good. Talk to me about the markets you guys are investing in, and why. Like, what are you looking for? What are the fundamentals of the marketplaces themselves that you guys are seeking when you're looking for another investment to get involved in?
Yeah, I'd say that, there's two things that you need people to have in order for them to be good tenants. And well, there has to be people, first of all, and that can't be understated. There's a lot of markets out there that are oversaturated with self-storage where there's just no one around. And so you want to stay away from that. Median household income is important because you need stuff in order to store stuff. You need stuff and you need money to pay for the service. So I'd say $50,000 median household income within 3 miles. 3 miles is usually key because most people don't want to drive much longer than that. I'd say 20 to 25,000 daily traffic vehicles, daily traveled vehicles. And it's important to remember that those vehicles, it has to be visible. You have to be able to actually see the property. If they're driving by and they don't see it, it doesn't matter. And, 50,000 residents, let's say, within a 5-mile radius. So that's kind of what we look for.
Okay.
Yeah, one more thing, because it's probably really important. One of the major gripes about this asset class is, people, they're easy to build and they're a great investment vehicle, so they're popping up all over the place. So it's important to look at markets that are undersupplied, especially within a 5-mile radius. So one of the things to do, this is back of the paper math, the national average is about 7.8 square feet per person of self-storage. So if you're looking at a market, you can pull comps and see how many square feet of self-storage there is and just divide it by the population in that area. You can get a good idea of where the market equilibrium is.
That's interesting. Okay. So that's pretty easy to do. So, I mean, you can essentially build a database out. I'm assuming that's what you guys have probably done then. There's probably some third-party companies that do these types of reports. So you can essentially look and find which markets you feel have a demand for this product that in an undersupply. Is that correct?
Yeah, and then obviously there's going to be some markets that are weird, right? So the more affluent markets that are more, vacation forward. So let's say lake communities where a lot of people have a lot of money. They usually don't live there. They drive to them for the weekend or something. So those markets, you should expect to see more self-storage, and you should expect to see those prices being higher than you would expect just if you're looking at the national average. But, other than that, each market's dependent, but that's kind of a good way to know if you're shooting in the right direction.
Sure. And the $1 million question, how are you guys finding your opportunities?
Yeah, great sponsors, leading sponsors in the country with a lot of relationships with brokers, but also, a lot of off-market transactions from weird stuff. It's clear to me just in all the deals I've ever seen, doesn't matter how large you are, the best deals you find are from these weird random occurrences that ended up just happening. It just seems like it fell in your lap, right? I'm sure you can relate to this as well, especially in the mobile home park business. It's like building a relationship with your neighbor who was always talking about his friend that loves self-storage facilities. And then one day your neighbor's like, and my friend's retiring. He wants to sell you his entire portfolio, something like that. Or even things as simple as this company had a similar name to our company. So we've been contacting with them, and it ends up that this guy's an owner-operator. He's got one property, doesn't want to have to go through the process of marketing the company, and just wants to sell it to you. So we've seen both.
Interesting. Okay, good deal. So you guys aren't doing any kind of, like direct mail strategies or anything like that. It's either a broker or just general networking, correct?
Yeah, just to be clear, I invest passively in these self-storage properties, so I'm not the one actually going out and sending direct mail in any asset class that I invest in. But I'd find that there are still on-market deals that can be lucrative because of the fact that there's many times a relatively big discrepancy between physical occupancy and economic occupancy that can be remedied, but can be deceiving. So some, like most sophisticated investors, if they see a property that's 88% occupied in a market that's 88% occupied, they don't spend their time on that property because where's the value add coming from? But the reality is there's, again, those line items, which when you're able to really effectively implement that change, the physical occupancy is very misleading in terms of how effective the property is being run.
Okay, you make a good point. So like those additional ancillary income sources could be, you said U-Haul, where's insurance, what are some of the other big supplies, boxes and supplies, what are some of the other big ones?
I'd say admin and late fees, and then just, a ton of underperforming in terms of rents. The rental incomes, the people are afraid that they're going to lose their tenants, and so that they're not aggressive with the rental increases.
Gotcha.
So it's frequent you can see properties 15% under market value, especially once you add all those ancillary stuff. Your property starts to slowly become an A-class property, and then you can lead the market instead of be the bargain.
Yeah, absolutely. So just so I can get a better understanding, like I do really good with like real examples or case studies. So, I mean, can you maybe share with us like a recent case study of an opportunity that you guys took down a value add opportunity, just so we can better understand like the opportunity you saw at hand and then what you did to add the value to it? Yeah,
so sure. We purchased a property not too long ago, 2013 in Fayetteville, North Carolina. This is a military town, so usually military, they make for good tenants in this asset class because their deployments are usually longer than the average stay, depending on the market you're in, depending on the tenant base. So, average tenant stays somewhere between 12 and 18 months on a national average or so. So that's a good starting point. The property was about 1,000 units, so a really large property, and we got a screaming deal on it at the time too. So it was definitely really favorable going in. 76% occupied at purchase. Market was 85% occupied. So there's obviously going to be some bump there if you have the ability to kind of do that. And the key here is just terrible management of the property. So I think I heard that the previous property manager had scissors that he was renting out to any of the tenants instead of selling. So this is the kind of stuff you see in the asset class. So instead of selling the branded merchandise, which can be effective for marketing, he was literally, and it sounds silly, right? Okay, you're thinking $7. Well, you'd be surprised how frequently people need those scissors to cut boxes. And so when you're looking at that $7 times whatever, times 12, times divided by a 7 cap or something, it makes a big difference, but also it just speaks to the mismanagement. So when you see something like that, you're like, okay, this is a really good sign. There was pretty much zero U-Haul component, and I'm an investor in this property, and recent quarterly reports, we're looking at somewhere between $3,000 and $4,000 a month directly to the bottom line from U-Haul alone. So that's a great value add. And it's going to protect you against recessions later down the road because you're just adding to the NOI and kind of buffering your position. Mandatory tenant insurance. This is something, again, that's not capital intensive, but was able to add about $2,500 a month. So you add those two together, let's say $2,700, $2,500 a month for the tenant insurance, $3,500 a month for U-Haul or so. I mean, it's literally $1 million in value that you can add. And so, we're really excited about the potential of where that's going to end up, but it's definitely a good start.
Was that a one facility operator that you purchased that from?
Yes.
Okay, that's a big facility. 1,000, or is that? I mean, is that kind of the norm? Or is that larger than the typical?
That was a large facility. Plus, the market dictated that we got a pretty good deal on it. So, in price per square foot basis, it was pretty solid. Not something that we can easily repeat, but again, that's where you find those deals.
So the big question I have is, barrier to entry. Like mobile home parks, cities, towns, municipalities, they don't want them. And so like our big stick is that like there's a barrier to entry. Like we can buy in great markets and we don't necessarily have to worry about a competitor buying up to 10 acres of land right down the road and developing a brand new mobile home park that has more amenities than ours or just has newer homes or whatever it might be. And so it's a really nice, comfortable feeling knowing that we don't have to worry about that anytime in the future. Our only competition are apartment buildings, which we're in affordable housing space, and new apartments that get built, they're not affordable housing. They're A-class, residences that are extremely expensive and are basically out of the price range of our demographic. And so how do you guys somewhat shield yourself from other competitors coming in? I mean, how do you basically cover that risk component?
Yeah, that's definitely a big and really important question. And I'd say that that's why looking at the market undersupply ratio is really key. Because if you're in a market where, and this is totally possible, if you're in a market that meets all the other criteria, is 250,000 square feet undersupplied based on national averages, that's very reasonable. And that can happen. And so what that would mean is that, let's say the average is about 50,000 square feet per facility, that 5 could potentially be built within that same radius before you'd see some downward pressure, significant downward pressure on price and occupancy. So that would be something that I'd look at. Also, I'm flying to Denver tomorrow actually to look at some potential opportunities, and they have banned building of self-storage facilities in these areas, in certain areas. So that's something that can come up too. That's the first time I've heard of that, but I'm sure it's happened before. But yeah, that's definitely something that can happen.
Okay, good deal. I'm going to switch gears real quick, if you don't mind, Hunter, and I'm going to, I guess, put you on the spot real quick. And so you've been doing this for quite some time, and you've learned a lot. You've been involved in a lot of transactions, and each and every day we're always learning, right? We're always becoming better investors, but knowing what you know today, the knowledge that you currently have, the wisdom you have, if you go back into year one and when you were first getting, you're dipping your toe in the water of the real estate investing space, what advice would you give yourself back then?
Oh man, this is challenging because, I feel like there's just, you obviously know that I started the business in 2010. So, who isn't going to say, man, I wish I had taken on more risk and taken on more leverage?
Yeah.
The reality is I am really happy with the portfolio that I built for myself as well as my clients because of the fact that those opportunities that I was doing at that time were great. And I think that the reality is my key that this has been true. This is incredibly true. And it's shocking knowing what happened in the market. But from my perspective, the deals that I'm seeing now are truly better than the deals that I was seeing then because of the fact that my network was able to grow faster than the market. So my capacity to analyze deals is obviously increased as well, but I am more comfortable with the deals that I'm investing in now than the ones I was investing in then because of the combination of my education and my network. So I think, and this is so true in real estate more than anything else, that the fact that the industry moves slow enough, if there's someone that's good at doing something, I mean really good at doing something, and they're saying it's an opportunity of a lifetime, it's going to be the opportunity of a lifetime in 9 months and 12 months again too. It just doesn't change like that. It's not like stocks. It's not like you miss it and it's over. So, if you meet someone that's pushing you to fund, build a relationship with them and verify it. And so that's kind of my pitch there.
That's great advice. And, lastly, this is where we enter into what I like to call the golden nugget segment of the show, Hunter. And this is where I'm going to ask you, if you could just leave our audience with one last final golden nugget of advice or wisdom. You give us a ton already, but one last final golden nugget of advice or wisdom that may inspire, motivate our listeners as they progress in their real estate investing career. What would that one last golden nugget be? And this could be core principles you live by, success habits. I mean, anything. What would that one last golden nugget be?
Yeah, sure. It's really simple. Just take action. It really doesn't matter what you do. You're gonna, make mistakes. And I'm certainly not in the point in my career where I'm out there giving speeches about how to be as successful as me, or it's nothing like that. What I'm just saying is I have made some really embarrassing mistakes. I have thrown networking events that no one's come to. I've done all that stuff that almost everyone does. But if you just be yourself and take action, you're going to be successful.
Yeah, no, absolutely. So let's talk about that for a second. So you threw a networking event, no one showed up at it, but you probably learned lessons there as to, okay, what am I going to do differently next time? Maybe I didn't advertise enough. Maybe I didn't talk enough, or I didn't mention it to the right people, the people that are going to have an impact and be able to spread the word, whatever it was. Maybe you held it at the wrong place. Maybe you held it inside one of your self-storage facilities, and it should have been held in the hotel ballroom. but I think that's great advice. Well, Hunter, this has been an absolute pleasure, man. I really appreciate you coming on the show and speaking with us today and just educating us on the self-storage space. And, for those that are listening, if you want to learn more about Hunter and his company, you can visit him at cashflowconnections.com. Again, cashflowconnections.com. And Hunter, that's all we have, my friend. I really appreciate you coming on, and I wish you the best success in everything you do. And hopefully we'll talk again soon, okay?
Can't thank you enough, Kevin. Thanks a lot.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.